Once an Indian entity is legally established, its next step is to commence its business in order to fulfill its objective. Indian regulations primarily give you the following options to finance your Indian entity, namely funding through shares, that is, funding by way of equity shares or funding by way of preference shares. Another option is funding through debt, that is, by way of external commercial borrowings or funding by way of raising loans from Indian financial institutions or banks. Another option is that you can use hybrid instruments to fund your Indian entity. Let's discuss each funding option briefly and individually. Firstly, let's discuss about funding by way of equity shares. As per Indian Companies Act 2013, equity capital comprises securities representing the equity ownership in a company, providing voting rights, and entitling the holder to return on investment through dividends or capital appreciation or both. The dividends are taxable in the hand of shareholders, subject to double taxation avoidance agreements, while gains on capital appreciation resulting from sale of equity shares are either taxable as short-term capital gains or long-term capital gains, again subject to double taxation avoidance agreements. The issue of equity share capital to a non-resident require compliances both under Companies Act 2013 and Foreign Exchange Management Act 1999. A startup Indian company is initially generally funded through equity share capital. Accordingly, a non-resident incorporating an Indian entity must plan its initial subscription through equity shares carefully in order to budget the expenses of Indian company till it gets monetized. Now let's discuss about funding by way of preference shares. What are preference shares? It is the capital which provides certain preferences to the holder of this capital over equity shares. The issue of preference share capital to a non-resident also requires compliances under Companies Act 2013 and Foreign Exchange Management Act 1999. Under FEMA and FDI norms, investment by a non-resident can be made in preference shares which are compulsorily convertible into equity shares. If investment is made in preference shares which are not compulsorily convertible into equity shares, then these are considered as debt in form of external commercial borrowings and are subject to certain additional conditions. Dividend is also paid to preference shares but in preference to equity shares. This dividend can be paid either cumulatively, that is one time at maturity, or non-cumulatively at fixed period. The dividends are taxable in hands of shareholders, subject to double taxation avoidance agreements. Now let's discuss about funding through debt. Primarily, funding through debt can happen through external commercial borrowings, or simply put as foreign debt. ECBs are borrowings raised by permitted resident entities from recognized non-resident entities. These borrowings are regulated by FEMA 1999 and Reserve Bank of India. All resident entities eligible to receive FDI can avail ECB from eligible foreign lenders. And eligible lenders can be resident of FATF compliant countries, equity shareholders, multilateral and regional financial institutions where India is a member country, and foreign branches or subsidiaries of Indian banks. The new ECB regulations have prescribed standard minimum average maturity period for various forms of Indian entities. ECB proceeds cannot be utilized for real estate activities or investment in capital markets or equity investments. The ECB borrowers are required to report monthly actual ECB transactions and its utilization in various forms prescribed by the Reserve Bank of India. The interest earned on ECB is taxable in India and liable for withholding tax, subject to double taxation avoidance agreements. ECB interest is also subject to thin capitalization norms under income tax. Further, if ECB is provided by an associated enterprise, then the interest is also subject to transfer pricing regulations. Another way to raise debt is by raising loans from Indian financial institutions or banks. An entity can also opt to raise a term loan or a business loan or a working capital loan from Indian banks or non-banking finance companies to meet its funding needs or day-to-day expenses, or to fund their working capital requirements or any expansion need. Examples could include infrastructure finance, working capital finance, term loans, letter of credit, and other kind of credits. A startup who doesn't have credit history in India may be able to raise finance or debt from Indian banks or to fund their working capital requirements or any expansion need, or NBFCs on the basis of counter guarantees of its non-resident shareholders. Of course, the interest paid on such debt is tax deductible. Another way to fund your Indian entity is funding by way of use of hybrid instruments, that is funding by various hybrid instruments such as CCDs, OCDs, masala bonds, share warrants, etc. They are also allowed subject to certain conditions and compliances under Indian Companies Act and Foreign Exchange Management Act 1999. Further to various discussions above, in case the business model of an Indian entity is such that it is serving as a back office or a vendor of the holding company or any of its foreign associated company, then it may transfer price at arm's length such revenue. Please note, the transfer price revenue has additional income tax and GST compliances and should be at arm's length with actual substance to be adequately supported through robust documentation. On another note, in case the Indian company is a customer to holding company or any of its foreign associated company, then the holding company or the foreign associated enterprise may transfer price at arm's length a charge to the Indian company. Please note, the transfer price charge has additional income tax and GST compliances and should be at arm's length with actual substance. The benefit of such charge to the Indian company has to be adequately supported through robust documentation.